Let's do a quick summary of revenue recognition. From Chapter 3, you know that revenue is recognized when it's earned. Earned is when we have provided the goods or services to the customer. The amount of revenue to recognize is the cash value of goods or services that has transferred to the customer. When companies are reporting their financial statements, their income statement will typically report net revenue. Net revenue is gross revenue, which is your total revenue, minus any sales discounts that you gave to customers, minus any sales returns and allowances. Sales discounts are discounts that are offered to customers to help speed up cash flow to the company, and sales returns and allowances are defined as the right to return unsatisfactory or damaged merchandise. So if you sell goods to a customer and the customer is not happy and the customer returns the merchandise, that will be shown under sales returns and allowances. These numbers that you see here are assumed numbers. So let's say you had gross revenues of $100,000 and you offered sales discounts of $1,000. You had $400 worth of returns. Your net revenue would be shown as $98,600. If there are no discounts or sales returns and allowances, your gross revenue is equal to your net revenue. Next, let's take a look at your accounts receivable. Receivables are the third most liquid assets on your balance sheet, and they represent monetary claims against others. In other words, we acquire receivables by selling goods and services or lending money. If it's selling goods and services, we call it accounts receivable, which is what you've seen so far. Sometimes we lend money to customers as well, and that is called notes receivable. We'll cover notes receivable later during the chapter. The accounts receivable account shows the amounts that are collectible from customers. The balance that you see in the general ledger is called a control account. Basically, a control account is just a summary account. It shows the total amount due from all the customers. To see what is due from each individual customer, a company keeps a separate ledger called a subsidiary ledger. The subsidiary ledger has a ledger account for each customer. Let's take a look at an example. This particular company has 3 customers who have customer balances. Customer A owns $5,000, customer B owns $1,000, and customer C owes $3,000. These individual customer accounts are kept in a separate ledger called the Accounts Receivable Subsidiary ledger. The general ledger has an accounts receivable account which shows the total of the individual customer balances. So if you add up these 3 customer balances, it totals up to $9,000. The accounts receivable in your general ledger is the total of $9,000. And the accounts receivable account is called a control account. A control account, again, is an account that summarizes individual balances.